Shannon Seery, an economist with Wells Fargo, and today I'm joined with senior economist Sarah House for a special look on U.S. inflation. So Sarah, a lot of people have been talking about inflation recently. It's definitely become more of a hot topic again. And we're getting a lot of questions from clients about how high prices could go this year. Currently prices still do remain pretty subdued as measured by the Consumer Price Index. Both the headline and core measure are up only about 1.4% through January compared to last year. But we are seeing expectations start to trend higher, and they're approaching levels that we haven't really seen since the mid-2010s. So, what's behind that pickup in expectations?
Right. So first and foremost, where we're seeing the push for higher inflation most immediately is coming from the goods sector. So core goods inflation is up at the fastest pace we've seen since 2012. And that's reflecting a number of factors. So one is rising input prices. So we've seen commodity prices, for example, they're up 20% year over year. But also we're seeing increases in input costs just from increasing bottlenecks in production and transportation networks. So uniquely with COVID, we saw this big shift in terms of consumer spending towards goods. And so you've seen this big ramp up in demand, but it's been tough to meet given the fact that you also have constraints with getting production lines up fully running with absences related to the pandemic. And so it's really caught manufacturers off guard too, where they have low inventories. And so all that's translated into increasing pricing power in addition to rising costs. Now, come this spring and summer, we are expecting inflation to broaden out and see more services inflation. So this reflects the fact that household balance sheets are generally in really good shape right now. So when you factor in that households haven't been able to spend as freely over the past year or so, and you've seen multiple rounds of fiscal support, we estimate that there's about 1.7 trillion in excess savings sitting among households. And so that's going to translate, we think, to essentially a burst of demand pull inflation later this year as the economy fully reopens and people have both the desire and the means to go out and spend more strongly. So that's going to be reflected in services, but should also lend continued support to goods inflation. So with that in mind, Shannon, how does that factor into our inflation outlook for the year ahead?
Right, so we are looking for inflation to rise this year, but the quarterly data will probably be a little lumpy. So we're dealing with some pretty tough base comparisons in the second quarter of this year. If you think back to Q2 of last year, that's when lockdowns were first instituted and pretty widespread across the nation. So that decline in demand really weighed on prices at the time, as did lower commodity prices. So as we look at this second quarter of this year, those year-over-year comparisons are going to be flattered by those low base effects of last year. Now, after that transitory pickup in inflation in the second quarter, we are looking for inflation to settle at a higher rate. And, that has to do with those comments you made earlier, Sarah, about the service sector and that increased demand that we expect in the second half of the year. But we don't have inflation getting out of hand in our forecast. And, we've talked about inflation expectations on the rise. And while that's true, they do remain within a recent range and aren't necessarily at a point where we're worried that they're going to lead to significantly higher prices. And the other thing I would emphasize is the continued slack in the labor market. So, continued slack there should keep a lid on employment costs this year. Now, Sarah, these are obviously two things that the Fed is paying pretty close attention to as they're setting monetary policy.
Right. So I think both the rate of inflation expectations as well as the ongoing slack that we're seeing in the labor market are going to be important components when we think about the rise in inflation we're expecting to see this year, but how the Fed responds. So we saw the Fed alter its framework this past summer, where they've now stated that they want to see inflation rise a little bit over 2% for some time. So it doesn't necessarily mean that just because we hit 2% or even 2.25% on the core PC deflator in the coming months, that the Fed's going to be ready to pull forward rates, that they are waiting to see where expectations rise to as a sign of perhaps how durable this increase in inflation will be. So whether it is just a temporary jump from the economy's full reopening or if it is more sustainable. And even if it looks like inflation is likely to run at a higher rate, we think that they're also still going to be paying pretty close attention to what we're seeing in terms of the labor market. So we're still roughly about 10 million jobs short of where we were prior to COVID. And so even if you see inflation picking up, it doesn't mean that the Fed's going to react to that if they still think that there's a lot of work that can be done on the labor market front by standing pat and keeping policy accommodative for a while. That said, it will probably have some implications for fiscal policy and how much additional support comes down the pike later this year.
Right. So even if it takes longer for the Fed to normalize policy, we might not see additional fiscal support in the form of additional COVID relief aid or even infrastructure spending if, the economy appears to be overheating. Well, Sarah, thank you for joining us. And from all of us at Wells Fargo Securities, thank you for tuning in. If you're looking for more analysis on U.S. inflation, please feel free to visit our website.